we had the lead up to Brexit, the Brexit, and now the stunning recovery. It doesn't surprise me that we had this recovery. I had actually tweeted out at the time. I know there was a lot of fear-mongering going on TV. A lot of the famous, I guess, TV pundits were saying how this was the end of the world, basically. And I basically just said they're being very narrow-sighted. I always am in favor of freedom. I think it's always the right choice. And in the case of the Brits, it was, I believe, most certainly the right choice. Their markets are basically at all, the FTSE 100 is at pretty much an all-time high, I believe. I have to check where it's been, and as is the S&P 500. Lagging economies have their own unique issues. We've talked about the unemployment problems. The one good thing that the United States can benefit from that is, I guess, unique here is that we do have a lot of natural resources. Other countries like in Asia and Europe, they do not. They do have very high youth unemployment, though, and that usually tends to lead to problems, such as in Spain and so on and so forth. It's remained rather calm. I've thought that things would have gotten a little bit more, I don't know, lively over there. I'm trying to think of a good word. Anyway, we had some economic data recently. We had the employment number, which everyone was very excited about. Let's break down some of that economic data. The ISM service number was, I said it was good enough to hold off the fears of an immediate recession. I'll say the same thing about the employment number. We had a really, really bad employment number the previous readings. There were some revisions back and forth on those numbers, but this number was considered good. The problem is of course, the makeup of those jobs. Waiters, waitresses, bartenders. I often joke around about carnival ride operators. That's really actually a thing. I mean, with the reaction of the market, you think carnival ride operators are the new lawyers and doctors, right? I mean, anyway, good enough, like I said, to hold off an immediate recession, but not good enough necessarily to get the Fed involved. There's really not that much wage growth, and they know that the job quality, no matter what Mester and George are going to say tomorrow, by the way, the Fed heads are speaking tomorrow late in the day, I think 1:30ish. Be a little cautious. Those rambunctious Fed heads tend to get a little hawkish, and they like to kind of just talk. I think it's quite clear after Yellen that there is not much that's happening, particularly after Brexit. I think everyone just kind of wants to see how that goes. We have the Bank of England overnight. They're going to be making some rate decisions. I think it's expected that they're going to ease. If they don't, we might get a little bit of flack from Europe tomorrow. We'll see how that plays out. My guess is I would think that either they'll do something or they're just going to say that they're prepared to do something, kind of the, the tough talk. I always love the tough talk, particularly out of central banks. I posted a funny meme I made the other day saying, ever since I could, it was the joke on Goodfellas, ever since I could remember, I always wanted to be a central banker. Of course, the homage to Goodfellas. But yes, they have gotten weak, I guess, easy money policy, I should say, has gotten us to all-time highs. So let's talk about where we are in the market and where I think we could be going. That's really what you guys want to talk about, right? So let's start off with the S&P. All right. So we all know that we had that run-up that day that was sort of it wound up being a bit of a false breakout. That was on, the date was 6/23. We had that breakout. It got a little crazy. It actually even gapped higher in the after hours. I said I didn't think that was the end of the rally because we don't tend to end legs in after hours or pre-market trade. However, it got quite steep and people weren't expecting the Brexit. I think that day, and this of course is speculation and we'll never know because it never happened. We got the Brexit, but I think if there was no Brexit, we might have gapped up and then wound up selling off and pinning that day at 210. It just had that feel to me. I actually was talking about trimming profits and so on and so forth into that ramp. It just seemed to me that it was no matter what happened, there was going to be some type of a sell-off. It wound up being really very dramatic because there was, of course, the Brexit. People hadn't expected that, and they were kind of caught off sides. And I think people just always assume when things don't go well that it's sort of the end of the world, particularly for us, right? There's not a lot of confidence in the economy or in the markets, even at all-time highs. Astonishingly, and I'm going to tell you this number really, I wouldn't say caught me first as a surprise, but it kind of confirmed what I had been thinking. I did a poll today. I didn't have much time to do it. I think it was less than 2 hours, and I had 183 replies. So I would have liked a little bit larger of a sample size, but 183 is pretty good. I asked, are you bullish, bearish, or neutral? And I put in the tickers, the hashtag SPY and SPX. 43% of people responded bullish, 29% of people responded bearish, and 28% of people responded neutral. The market just made an all-time high, and less than 50% of the people are bullish. That, to me, is bullish. It means that there's still a lot of people who are not believing. There is no euphoria in the market. I'll take it from somebody who has traded in euphoric markets. I traded in the 90s, and I will tell you that was a euphoric market. I've actually never seen anything like that in my before or since. It was incredible. I mean, you would be talking about, I remember I was trading at the time. I was still in college. I would go into class. I'd long up on Amazon. I would come out after my class, and I'd be up 17 points in a couple of minutes. It was something to behold. I remember days when eBay was up $8 every day for almost a 300-something point run without a pullback, straight $8 every single day for 300-something points. Again, these are unheard of things. Qualcomm at the time, I remember they split. There was a big split, 4 for 1. They were up $100 in the regular trading session, and then another $100 in after hours. That is a euphoric market. Everybody could only see how high the sky was. That is not the case here, not with these numbers. And these are facts. I traded this market. I remember when this happened. I remember being filled on Qualcomm, by the way, on that run, and not getting a trade confirmation until the stock was $8 higher. I was lucky. I was happy it wasn't $8 lower. That, as crazy as that sounds, that's how quick markets used to move back then. That's a euphoric market. This is not a euphoric market. No one believes it, no one thinks it's happening, and that's exactly why it's happening. The market likes to inflict the most amount of pain as often as possible to as many people as possible. And I'll tell you, I had some quite heated discussions. I'll tell you, everyone's all excited about this new Pokemon game. My new excitement is blocking people on Twitter. I'll tell you, I've been very active the last few days. It's actually quite entertaining. I've kind of grown to get quite accustomed to it, unfortunately, and I have a lot of very vocal people who just are disrespectful and haters, and they're wrong. I mean, I know it's hard to be in a position when you're losing money, but I've seen what amazes me, and this is just going to sound. Just think about this. Just try to digest this. I always say, don't add to losing positions. It's just not what you want to do. When you add to a loser, think of it like this. You're trading in your spade or your shovel for a bulldozer because it's going to probably going to get worse for you. And you're adding to losses. I had people I saw on these moves in the market, who have been short, and obviously they're all underwater and wrong because the market's at an all-time high. And they're bragging and boasting that they're adding to their shorts like they're adding to profits. Like, it's like high-fiving. I mean, absolutely incredible. I shouldn't say I've never seen anything like this, but it was absolutely astounding to me. So the more I see that and the more I see polls like this, it makes me not think that the top is in. If you have 28% of people neutral, I'm assuming that's cash on the sidelines, and still 29% of people that are short or bearish, it seems to me like that the market is going to eventually, at some point here, move higher. That doesn't mean that we can't have some pullback, a few days, or some digestion like today. Today was a pullback day. my take on today, and I'm just pulling up the chart here, is that it was just consolidation. The breadth today never really got more than in the 2s to 1 negatives. The NYSE finished down 1.11 to 1 negative. NASDAQ was 1.47 to 1 negative. The MOC wound up flipping from sell to buy. I will give that. It was the defensive names that kind of did the rallying. You know, back in the day, it was like the AOLs and the CMGIs that were the big studs. Now it's like Clorox and Smuckers and stocks like that. This is, of course, all the chase for yield, which we'll discuss in a minute. Anyway, with regard to SPY, you had a multi-day consolidation. This was the first, the second, the third, even the seventh. I'm sorry, it was the first, the fifth, the seventh, and the seventh. And then after that, we've now extended past range. I've talked about the mini wimpy head and shoulders, and then maybe the bigger boy and girl head and shoulders. They've all failed. Anything, in my view, I had given the levels back then. I said anything above 205 quarter to me was still okay. That was the day Yellen really flipped from, this was like 2 pressers ago. Anything above that to me was still okay. We had a couple of days below there and then rocketed back up. What the Brexit break told me was that it was more of a liquidation break variety, and when you get a sharp pullback like that and it just sits, that's the beginning of a bear market. When it rallies back up really quickly, that is more of the characteristics of a bull market, not a bear market. People don't understand price action and context, whether you believe it or not. I remember, I don't want to mention any names, but like on day 1 or 2 of the rebound, I had people saying, "Oh, it's going to close negative. It's it's bad. It's this and that." And like day after day, kept on messaging me, "Oh, it's going to just close negative. Just saying this and that." They didn't understand that the Brexit didn't really matter. It was actually a bullish occurrence for England. I don't want to get into that and the politics of that, but it's good for them, and it's, I think, good for us. Anyway, the markets obviously rebounded very quickly, and we're at new all-time highs. The levels of support that must hold for this thesis to stay intact. All right, so the old all-time high was 213.78. Anything above that remains bullish. That's it. Just there is no negotiations there. 212.52. That was the last kind of swing high in the leg. Anything between 212.52 to 213.78 remains bullish. There is no negotiation on those levels. The must hold, in my view, remember what I had talked about, the levels that have been the major resistance here? Between 210 and 211. That is the must hold. If we get pullback beyond that, it could get a little bit squeamish. There's the gap fill at 209.53. Anything, though, above that level is okay. I'm willing to give a little slippage to 208.97 to that 209.53 gap fill, but you don't really want to be below 210, 211. That was the ironclad resistance that we kept on banging into and closing at and pinning and couldn't get through. We're through. What was resistance should be support now. That's it. We don't change the levels when we get there. We don't make it, negotiated to fit our thesis. Those are the levels, the must-hold levels. Anything above there, and we're talking now about Fibonacci extensions to the upside. So what would those extensions be? If you measure from the pre-Brexit high, that would be the 212.52 to the Brexit low, which was 198.65. There's a couple of different ways to measure it. I'm just using this as the simple one. The 1.272 fib extension is 216.29, and the 1.618 is 221.09. Yeah, we could be going there. It doesn't seem so crazy now, does it? I don't know that it's going to be a straight shot up there. It wouldn't surprise me, honestly, with this market if it was, but we could have a pullback and then grind our way up there. That's sort of what I think is going to happen. It's just going to be like this slow grind. When you start getting to the end of moves, is when it gets really steep, that parabolic move, when you get like, big up day, followed by big up day, followed by big up day. That's like the end, when the volume expands. This is also, by the way, I mentioned this in a video a couple of weeks ago. I don't remember which, it was Periscope or on, I think it was actually in a weekend review from, I think, 2 weeks ago. The way to use volume is this. People, for some reason, when you turn the TV, I'm going to dispel 2 rumors right now. One is how to use volume, and the other is the relation of bonds to the stock market. So let's discuss this here for a minute. Volume. People always say, I hear this all the time, and it's maddening to me. I just want to like throw something at the TV. I won't do that because replacing 65-inch televisions are expensive. Anyway, the story here is they always say that the volume was light on the rally, that you can't believe it because the volume was light. To me, that means that there's more to go because you don't have everyone in. Think about a crescendo low when you've had multiple days down and then there's that big volume spike down, the washout, all the capitulation. That is the same on the upside. When you get that big move up, that massive move up after you've been up day after day, and then there's that big gap and go, that exhaustion gap at the top of a range, and the volume explodes, that's all the capitulation, it's all the suckers being dragged in, it's not the smart money, right? So low volume on the way up isn't necessarily a sign of bearishness, it's just a sign that there's no one believing and it's not capitulatory. Usually when you get the extremes of volume, they're at the bottom of a range or at the top of a range. What I like to see to kind of confirm, let's say, a low, is that you get this kind of washout with big volume, and then it either rebounds quickly or you start making slightly lower lows on decreasing volume. That's usually when the end is sort of near. The same for the big upside. You make that big move up with the volume, and then like you start making smaller highs, on lower and lower volume, and then it's petering out. It's sort of the end of the auction, so to speak. If you're familiar with market profile, you know that there's, I guess, the end of the auction happens when you get taper, right? When volume starts to taper, you get the expansion of volume and then the taper. Often you have single prints of TPOs or double-digit TPOs at the top or at the bottom. Same thing goes for stocks and trading. It's just on a longer time horizon. Number one rumor there, dispelled. Number 2 rumor that I'm going to dispel. I guess TV reporters, in all of their infinite wisdom and vast experience in trading, forgot to take Finance 101 or any central banking class, any valuation class for that matter. The friend of markets and discounted cash flow valuation, DCF, is a lower interest rate. There is simple math here. This is just division. You have a top number and a bottom number. A big portion of that bottom number is a discount factor, meaning the return that you have to divide by to get to your goal. The risk-free rate, also known as interest rates, is a big component of the lower number. Think about this. Again, I'm going to keep it real simple for you. Straight division. You have a top number and a bottom number. If you have a lower bottom number, that's the divisor, the one that you divide the denominator into the numerator, the end product is larger. If you have a larger denominator, meaning higher interest rates, the end product is smaller. That's simple. It is that simple. Unfortunately, they always say if the bonds are rallying, meaning interest rates are going lower, that lower number is going lower, that the market should be selling off. Exactly the opposite. The only time that logic makes any sense is when you get spikes in bonds, because that makes people fearful that there is a recession coming, meaning earnings capacity, the top number might be in jeopardy as well. That's the difference. I don't think I've explained that before in quite such mathematical terms. I've always talked about the spike, but what the spike implies is that the top number also is going to have problems. So not only is the lower number going down, but the top number might be going down at a quicker rate of change. That is the big fear. The same thing if interest rates go down. If they go down gently, there's no big deal because things aren't changing that much. The interest rate, the sensitivity. If you're curious about interest rate sensitivity as related to bonds, I would suggest Googling convexity. I don't want to get into that right now, but if you ever, by the way, hear people on TV saying convexity doesn't matter, that will be the peak of the bond market. Seriously, I'm starting to hear some talk like that too, which is starting to actually get me a little bit worried with regard to interest rates. But we'll save that. Let's table that for now. I don't think it's a relevant discussion for the purposes of the time frame that this video will be relevant. Anyway, and I'd like to discuss that a little bit more in the more technical videos that I do, the weekend review videos. So why not leave that as a teaser? That could be a coming attraction for the potential bond issues to come. Anyway, if bonds drift lower, they just have a normal pullback, it's okay. When they start going down quickly, it starts raising the interest rate higher, and that lower number starts getting jacked, right? And the end product becomes lower. This all has to do with PE multiple premium or discount. Again, the media doesn't understand this because they, I don't know, they, I guess they don't teach DCF valuation in makeup. Anyway, here's the story with that. I'm trying to think of the easiest way to describe this stuff. If interest rates are rising, and they're rising quickly, like I said, the bottom number there, the denominator, is getting larger. You have a lower end product. That means that bonds, if you were to buy them freshly, like not the ones in the existing market, or even if you were to buy the ones in the existing market, you would be wanting a higher coupon rate. That's what they. That's really what they call like the dividend for stocks. For bonds, it's called a coupon rate. I don't want to get into the various different types of bonds, like strips and so on and so forth, but we're going to keep it real simple with straight out treasuries. The discount or premium you'll pay to it is determined based on the interest rate. As interest rates rise, their competitiveness to stocks go up. We all know that in 2000 and in 2007, and actually even in 1929, interest rates before the big crashes peaked at 6%. The Fed has already told us that the new normal, the new 6%, like the new 50 is 40, for example, or the new 40, whatever, everyone's always saying that the new 6% is just only going to be 3.5%. So interest rates will stop rising, at least the Fed will stop hiking at 3.5%. They've already told us that will not happen for years to come. So what has happened? That has forced people who would normally be maybe risk averse to who buy CDs, who buy treasuries, they can't live off that premium anymore. It's not enough. So what they do is, yes, bingo, they chase stocks. That is why companies like, let's just do them one at a time. These are the big studs in this market. It's not. That's why Philip Morris, a very low growth instrument, although I like some of these stocks with the vape cigarettes. That's why they're trading at 25 times earnings. For contrast, Google, which is arguably one of the greatest creations ever, is trading at current earnings at 30 times earnings. Forward earnings, it's trading cheaper than Philip Morris because they don't pay a dividend. J&J, they make Band-Aids. 22 times earnings. Amazing, right? What's another one? Coca-Cola, they make sugar water. Some bottled water. 27 times earnings. That is to chase a 3% yield, by the way. That is how desperate this has gotten, and this is why those numbers of people who are skeptical on stocks are so high. In the end, and I will concede this, I could never argue this point, this will end horrifically. Very, 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 very badly. there will be a very, very large correction or crash or whatever. It's going to be very ugly. The 3% that you're making to chase 27 times earnings for Coca-Cola will be nothing compared to the 30% or more, now that these things have been chased, that you will lose in terms of share price. The problem is that could happen years from now. It might not happen long, now. It could take years. And that, if you're short, could be, the market can stay irrational longer than you can stay solvent. That is exactly what is happening right now. That is the state of affairs. You think about the game of musical chairs. I've had a gentleman call me. One of my works for my brokerage account. Very nice guy. He usually calls me around the summer. He always seems to call me when I'm on vacation, though, which is whatever. And he always asks me, he says, Justin, do you want to put more money in your account? I can give you, this and that and blah, blah, blah. And I say to him that, other than my trading account, I'm not really putting more fresh money into longer term plays like these because of the exact scenario that I outlined. And longer term thinking, I think in different time frames. I'm right now on my longest time frame. Whenever I think about by the way, most people put more money into the market. They very rarely take it out. I like to do the takeout. I take out a lot of money. When I make money, I take it out. That pays for my apartment, my car, dinner, whatever. It funds my lifestyle. So when you have profits, my advice to you is remember to take some out. That is one of the biggest lessons that I have learned over the years in the market. Always take money out when you can, not when you have to. If you've had a big run, take some out. Just sit on it, do whatever. It's really key for risk management. You'll never hear that from anyone other probably than me and maybe Jesse Livermore, but he's unfortunately not around anymore to teach that lesson. And Livermore really discovered that later in life when he was already old. So that's my advice. Anyway, so longer term thinking. So I've had this conversation with him a couple of summers. I've said, the market. This really kind of started after 2013, actually. So I said to him, yeah, sure, the market could have some more upside, and that was right after the big up 30% or whatever. That's usually when retail clients are piling in the most money, right? And the smart money is usually selling. We've been sideways now for the better part of 3 years, so I don't feel like I've missed out on anything. So I said that really the big money to be made, and when I'd be interested in putting more money back in, the money that I've taken out, is after the market has had a really, really big crash. So I can invest and put that money into some of these dividend stocks that everyone has chased up to 30 times earnings when maybe they're trading 14 times earnings after they've gotten slammed. So that's my thesis on if you want to put more money into the market. By the way, on a side note, if you ever have a margin call or whatever and you're called to put more money in, do not close the position. Just some advice. Everyone will always do what they want, but I assure you that is the better play. If you're wrong, you don't want to put good money after bad. That's my series. So someone just asked me, will the 7-year market cycle hold? My theory is that the 7-year market cycle is busted because of the Fed. The thesis of we are in unprecedented times. Interest rates can't even hold above 2%. They're like 1.5% or something. That is extraordinary. I don't see the Fed entering a true hike cycle. For a while, they hiked in December. In the past, the Fed has gone, every consecutive meeting. Now, I think they were hoping to really go every press conference, but the numbers, the data hasn't played ball with them. The world is changing very, very rapidly. This is actually a really great question, and this goes into my longer-term thesis on the market. So we've seen the numbers, the economic data, for example. The economic data has fluctuated, right? I believe that we are involved in not a business cycle, but we are involved in a refresh cycle, meaning that we get momentary blips in the data that's sort of like a false dawn, and it's just restocking. meaning inventories have been depleted and they restock them and it comes back up. I don't think it's a boom-bust cycle in the traditional sense because we can't even hold on to 2% growth. The big economies like China and India, they're growing in 7-8%. I think they're having more typical cycle. I think they're really transitioning from more like frontier markets to they're becoming even more developed markets. They're not quite there yet, but they're trying. But we're not in a typical business cycle. We're in a refresh cycle where we refresh, the economy gets a little worse, we refresh a little bit. So I guess you can say it's your sine wave business cycle, but it's really not. It's a refresh cycle. You don't see employment really getting marginally better. You don't see any wage growth getting better. Like in a typical business cycle, you would be worried about a hot employment number because that tends to mean that you'll have inflation pressures because of wage growth. Even when you get hot employment numbers, the wage growth is like infinitesimal because they're in crappy jobs. Waiters, waitresses, bartenders, carnival ride operators. I mean, when you got guys going out to bars picking up chicks, telling them they run the Ferris wheel, you got problems, right? So that to me is the issue. Someone just asked about stagflation. We don't have we have screwflation. I think that's really the kind of technical term. Stagflation means that you have stagnant growth with inflation, but the inflation that we're getting isn't in the inflationary reads that would trigger the Fed. We're getting it in things like healthcare, things, food and energy that they don't necessarily count. Although energy has come down quite a bit. Although I'll tell you that is a big component, and the Fed doesn't necessarily officially count that. We all know they look at the oil numbers, but they don't officially count it. But yeah, we're getting what I consider screwflation. If you look at the big increases in what consumers are spending more money on, there's studies of this. A huge percentage of it is going toward rent because we're 6% or even more at this point over the norm of people renting to owning, and it's going into healthcare. I remember the last few years I had 17% year-over-year increases in my healthcare, and then it was like 30%, and now I don't even know. It might even be more. It's absolutely incredible. You have premiums going up, you have deductibles going up, you have benefits being cut, you have higher prescription copays, you have higher doctor copays. I mean, it's absolutely out of control. So that system is going to, by the way, going to collapse on itself within the course of the next couple of years, I believe, or it's going to be adjusted. There's no way that it can sustain itself in its current model. The model was broken. They had assumed younger people were going to sign up, and only sick people have signed up for it, and younger people who are living in their parents' basement till they're God knows how long. They also increased that, by the way, how long you could take a child as a deduction. So you've now encouraged people to kind of stay home for longer. These are the big macro themes. This is really what I love talking about on Periscope, by the way, because I can't show you the charts. This is like the points of clarification, that kind of bigger picture thinking, the AI conversation, or really explaining why this stuff goes on. God knows they don't do it on TV. Anyway, let's get into a little bit of the technical stuff, and then we'll wrap up. We covered a lot of great stuff today. By the way, my mom spent a fortune for me to learn this, by the way, in business school. A lot of this does come from business school. The trading aspect of it comes from just trading. Being out there and doing it. I remember. Briefly, I went to go work for an investment bank out of college. If you want to hear an interesting, cute little anecdote, I'll tell you. I had taken exams in school and I aced them in an options class. I remember I got an A or an A- on an exam once, and I left the classroom not sure if I passed or failed. I wound up having like the third or fourth highest grade in the class of like 500 people or something. So I guess the die was cast back then. But even after graduating college and having, I guess, known on paper how to trade options, you don't really learn it until you do it. You have to really learn the volatility aspect of it. You really need to know your Greeks. I get a lot of questions from people, and honestly, some of them should not be trading options. Like, you don't really want to buy weekly premium. You want to be a seller of it. Like, I love to often sell weekly premium to buy longer dated premium. if you buy weekly premium, you're assuming that you get the direction right immediately. There is no time to kind of be wrong because the theta burn is so, against you. Also, a lot of the mistakes people make are they buy weekly protection, like to hedge against an employment number, and then they don't realize the vega is going to collapse at the, once the number is out, the volatility, because the event is over. So you get the directional move, but you might not necessarily make money on your trade. Isn't that the worst, when you get the direction right and you still don't make any money on it? That effing sucks. That's also why I tell people not to trade the VIX directly. It's usually factored in, and unless you get like a major outsized move up or down, you don't make that much money on it. The correct way, someone asked about the VIX, a lot of people asked about that. The best way to play the VIX is to use it to buy premium or sell premium in stocks or in SPY in particular. VIX is really the S&P, the SPX. So the VIX is on the range low right here. We didn't quite close below it. We had a bit of a look below and fail yesterday, below the 1280. I said, remember in the weekend video, I always assume everyone watches all my videos. I know they don't, but anyway, I like to think that. But we all know that the VIX has an inherent value. It's not going to zero. Anything, by the way, in 2007, it had a look below 10, and then that was it. That was lights out for the market. So if you get a look below 10, you probably want to load up on some puts on the S&P. But, someone asked me, is it a good point to buy, to short? I still think the market probably can go a little bit higher. I can't say that you don't want to maybe hedge here or buy some puts. They're cheap. This is the point in time when you probably would be looking to do some of that hedging. I don't think that you're going to get necessarily a huge spike in VIX from here. I think it's going to be more of that like sideways chop action, like I've illustrated in the videos. Again, another great tease for my weekend review video. I think it's going to chop and go sideways here with kind of brief blips in volatility that you're probably going to want to use to sell some out of the money premium. The market, for all intents and purposes, until we get some solid closes below 211, is still by the dip mode. That's just how I believe it is. So would I be buying calls on the VIX here? The answer is no. I would be buying puts in SPY if I wanted to play the low VIX, and I'm bearish, which I'm not really at the moment. I'm a little more, like I said, I'm more in the buy. I'm not into chase the all-time highs here. A lot of the buys I made, I've been lightening up. If you notice my stream, I'm talking about booking profits in Hertz the other day. There are some plays that I've talked about some longs into, but like, for example, with like PayPal, I talked about it in the weekend review video. Holy cow, was that like an immediate winner. Speaking of PayPal, I want to talk about the psychology of that trade briefly. Actually, I'm going to save that for the weekend video because I really want to show the chart on that. That is actually going to be an amazing, amazing pattern that you can replicate again and again and again. I do that with professional gaps all of the time. They are very consistent money makers. We'll talk about both to the upside and to the downside. We'll talk about PayPal in the weekend review video. So that's my story on VIX. I think it's just going to go sideways for a little while. It doesn't necessarily have to confirm the market at range lows with making fresh lows. If it starts making highs, higher lows and higher highs, then there's a little bit more to worry about. Yes, someone asked, PayPal was a professional gap. That I discussed it a little bit in the weekend review video. That is considered a professional gap. When you get a gap above range or a gap above a downtrend line and it goes, that is a professional gap. If you can identify professional gaps, you will make a lot of money. So that's the VIX. The Qs. So the Qs aren't at all-time highs. I think they might be going. A lot of that is going to depend on a couple of stocks like the Apples and the Googles. This doesn't tend to be their best quarters, by the way. Yeah, biotech. If you look at XLK, though, that is breaking out. So that's the tech index, right? So that, I think, bodes well. I don't really get too scared about Qs unless you start losing 104 to 105. I'm going to up that range a little bit. The good news about the Qs is that we, for the first time, though, did make a higher high over the range. It was a bit of a look above and fail. the last day or so. But as long as we hold like 109.38, it's not an arbitrary number. It was actually the consolidation range low before kind of the breakdown. As long as we hold 109.38, I'm a little bit okay. That would, or we might not even get necessarily that low. Like 110s are the backside of the kind of the narrow, like the very flattish kind of downtrend that we just breached. So yeah, 110s to 109.38, I'm still okay. Below there, it starts getting a little iffy, I would say. What are some other names on the list here? Oil. Let's talk oil. So there's some good news and some bad news with oil. The bad news is that it looks like it might want to correct a little bit more. The good news is that Exxon isn't falling apart, which to me means that like we had a major recovery today. Oil, for example, was down. Oh, wow, actually, oil is it? No. It's trading in after hours. It was down a lot. Like yesterday's close was 46.62 and today's close was 45.11. That's a big move. Exxon finished down 7 cents. So you need, when you want to gauge oil, if it's in trouble, you need to see Exxon and XLE fall out of bed. XLE is just kind of consolidating up near the highs. It is still holding kind of a trend line. It was a mini kind of gap fill. As long as that's holding like the 50 MA, I think it's like kind of okay. If it loses it, then we're talking 200. Exxon just looks like this thing wants to go on autopilot to $100, or at least close to it. It finished up almost near the highs today. So you have 2-day highs in Exxon. I will say this. I want to start selling some rallies in Exxon because we're getting close to the channel high, which is right now, if it were to happen tomorrow, like close to 96 in the 95s. 97.25 was a reference level also. So let's maybe take a little profits on the pops on Exxon. But like I said, I still think this sucker wants to go. And I'm very interested in buying the dips in Exxon, like to channel low, which would be roughly around 90. The 90.56 right now is the 50 MA. I'm very interested on 50 MA touches. Someone asked me about Cliffs. I probably the person I was tweeting with. I didn't notice the name. Cliffs to me looks like a rounded bottom. It's a little late in the rounded bottom though. Yeah, I would buy the dips on this. It's let's keep it simple. This really goes into my methodology of how I like to trade. I like to buy stocks that make higher lows and higher highs. I like to sell stocks that make lower highs and lower lows. When do I like the order in which I use for technical analysis? Horizontal supports or resistance levels, trend lines, Fibonacci levels, and then moving averages. That's kind of the order that I follow. Someone asked me today about how much size I put into a trade. It sort of depends on how confident I am in that particular trade, if the sector is going my way, and if the market is going my way. So, for example, if we got a trend line touch that coincided with a gap fill and a 61.8 Fibonacci level, I have a lot of things going for me. That, by the way, almost never happens. When it does, you jump on it. I would take more size in that than if I only had a trend touch or that didn't have a horizontal support. But I like to kind of, I talk about right or right out, so you can, if you want, go in size at that level, and then, it's kind of a quick stop out if you're wrong. If the market is not trending, or if I like something and the market is kind of listing lower or iffy, I'll go in smaller size. If I'm in a bull uptrending market, I'll go bigger size. It all depends on the context in which we're talking. Are there big macro events? That's just the feel of the market. It's sort of, is it smooth sailing? Are people in a good mood? Is the market in a good mood? That's really how my confidence level is with regard to how I trade and my size. Someone asked, how do I set the stops? As soon as the trade, my thesis for the trade, the entry is negated, that's the stop. You got to give yourself a little bit of room to be right, but let's say my let's say my trade is a retest of I'm getting long at a retest of a neckline. Like we had a breakout and it's retesting there. If it doesn't hold the breakout, the breakout level by like, $1 or something, it depends on the stock. Like if it's Priceline, for example, you can't just use a couple of cents. If it's a smaller stock, within, a couple of cents or, within a point or so of the entry. Like, for example, PayPal. Let me use that one since that was a real popular one. We'll come back to finish up Cliff's before we end, though, I promise. PayPal. So my entry on PayPal was on. I bought it on Friday. This is going to be a little bit of a. I'm going to show more of this on the weekend review because this is just such an amazing entry. I bought it. Someone pointed it out to me. I think it was June, or someone who follows me asked me about it. I had been watching this stock, and it kind of gapped. I didn't realize it. They asked me about it, and I said that I liked it. I liked it long. It looked to me like a professional gap. I bought it. I didn't pay the high of the day, but I got in kind of closer to the high than the low of the day. That's also typical of a professional gap. It's the gap that doesn't let you in, and it's hard to buy because you didn't get good trade location. I've seen this movie before. I know how it ends, and it doesn't matter. The first day, if you're in on the first day, you have good location for the most part. I mean, unless it's up like, 80 points or something. But anyway, I had that entry, and it basically got up to some of my targets today. One of them was $40. It got to $39.99. I've been looking for like a retest of 40-30-ish area, between 40 and 40-30. It basically got there. So, excuse me. I'll be looking to sell somewhere between there and 41. If we were to lose the low of day today, I probably would trim some of the position. Simple. That's just plain risk management. However, if we were talking about Friday on the initial entry, I'm sorry, was that Friday? It was 7-8. I think that was Friday. I just want to pull up my calendar here quickly. So much for quickly. Yeah, Friday was 7-8. So I bought it Friday. If I were to have lost half of that candle of that day, I would have started getting a little bit nervous. If I'd have lost the low, I'd have been out. Completely out, because to me that would have negated the trade. It would have been a failed setup. Does that mean it can't go higher after that? No, it could turn around and go, but my thesis and entry for the trade would have been negated. So whenever the setup is negated, I'm out of the trade. If I'm trailing up stops, I like to take profits into reference resistance areas if I'm long, or if I'm short, into reference support. So, you cover as things go down. As price moves, a long or a short isn't as attractive. Like, for example, if you were short IBB and you shorted the neckline, breakdown at 360.57, it wasn't as great of a short at 275. Like the first time around, whatever, 280s. There was quite a large bounce. It always, it depends on like the context of how far you've come, how fast you've come. A lot of it is feel and reference areas. For SPY, for ES, do you have trigger stops? Yeah, I have triggers. You have to be a little careful with them. You have to set them. You don't want to set. You usually want to set a stop a little bit below the level or a little bit above, because algorithmic trading, they know to look above and to look below. So I usually like to make it a bit of an odd number, if it makes sense, one that they can't pickpocket me with. That's and I know for a fact they do that because I've talked to market makers that run those algorithms. Let's finish up with CLF here. Someone had asked, actually, we'll do one more after that. We'll do CLF and then CSX quickly. So the CLF is moved a lot. I think the stock eventually will go higher. It's hard to say that it ran from $2.82 and now you're first buying it up in the sevens. I would wait for a pullback, maybe the fives, into the fours. That's kind of midway in the breakout. Throw a Fibonacci level on it. sometimes you just got to say you missed it. But I think it's a buy this, as long as it's making higher lows and higher highs, it's a buy the dip stock. If it looks like the pattern wants to change. Same thing, by the way, for CSX. They were supposed to report after hours. They didn't report after hours. They reported RTH. I wasn't quick enough to get my trade off on that, which is really annoying. If there was a quick pullback to somewhere between 27.26 to 27.5, I'd be interested in a right or right out long there with a stop below today's low of day, which was 26.76. It should not violate that low. If it did, it would be a right or I'd flip from long to short in a heartbeat. So that would be my view on CSX. I think it's going to go to 29.5, maybe a little higher. There's actually a channel I drew in. But the pattern on that stock seems like that actually is a failed head and shoulders. I just noticed that now. On a bigger time frame, it's actually a head and shoulders, and on a short time frame, that's a failed head and shoulders. When a head and shoulders fails to the upside, it's usually quite epic, and it will go higher. I believe that stock is going to go higher. Actually, I'm glad we discussed this because I hadn't noticed the head and shoulders setup. I had noticed the inverse head and shoulders, but I didn't notice the head and shoulders. That is now a failed head and shoulders, and the stock should go higher. As long as you are above that failed right shoulder, which are actually the exact levels I gave, 27.26 to 27.41, I said half, the stock will go higher. Back into below there, it's a little bit more iffy, but I would say that the pattern is shifted and it's bullish. That's CSX. Anyway, that's my story. I'm sticking to it. If you caught this video late or want to rewatch it or whatever, it's going to be on my YouTube channel. I'm going to upload it now. Anyhow, the weekend review video will cover some of the stuff I wasn't able to make here or that you really need more visual references for. But I hope you guys enjoyed the broadcast. We went quite long, a lot longer, actually about double the time that I thought we'd go, but I think we covered some really good stuff. I hope you guys I hope you thought so as well. Anyhow, have a great rest of the week and cheers.